This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings. Welcome to Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by our macro advisor, Edge Manager, Craig Shapiro, on this Thursday, April 4th at the close, where VIX has closed, 1654. It's up about 16% on the day, and SPX is down a resounding 1.23%, and the Qs are down 1.5%. on basically headlines of war drums and specifically Israel and Iran. So basically this all happened on a quiet Thursday afternoon where Craig and I were just talking about how, we had time to discuss the agenda before the webinar. And no, there's been way too much positioning updates and such with clients. So long story short, we're here now. We'll get all caught up. And Craig, how about you take it away and give us an update?
Yeah, I thought we were going to talk about the data that's coming out tomorrow and on payrolls and next week CPI and all the Fed speak that we've had this week, including 6 or 7 speakers today and another 6 tomorrow. We'll get into all that, I'm sure. But it seemed like the market for whatever reason started to get more concerned about the resumption of Middle Eastern strife in the late afternoon today, and which is weird because I think I had thought that this stuff was out earlier in the day on these Iranian military bases being attacked and the CIA having possibly warned Israel of attacks coming from Iran as retaliation for when Israel attacked the embassy a couple weeks ago. There's also some talk, I think, from Blinken this morning that Ukraine would be added to NATO. And so, look, I think these things are always festering in the background, and it's never really clear if and when the markets will care. But, for whatever reason, it started to pick up some momentum this afternoon. And in light of where we were from a gamma positioning perspective, the zero gamma line is in the, low 5220 area, kind of moves around, and 5200 obviously is a level. So
we were already in it yesterday, actually. So this news.
Yeah. So we were in it yesterday, and then we were up this morning. So it kind of neutralized it, but you drop back through it late in the day like that, and you wind up in a situation where the selling begets more selling and volatility picks up, and it exacerbates the move to the downside. And it seemed like all day there was zero data expiry call buying all day, so it kind of
and also large positioning in April. In fact, I saw it and I was talking about it in the live trading room, and I also put out a post that I still thought it was I smelled a bull trap. So it was literally 49 million came in for the 529 out of the money SPY calls. They bought them, not sold them. And it was for this April expiration, and it just, call it bad timing. But in any case, the news, like you just mentioned, 27 killed in simultaneous attacks on 5 Iranian military bases came out, I guess, 7 hours ago, maybe 8 hours ago. VIX didn't spike until 2 p.m. And when I'm looking through the news feed to see what happened around that time, literally at 2:05, Blinken said, U.S. policy will change if Israel doesn't change course. And then Bloomberg kind of picked up on it and said, senior Israeli officials have reportedly received intelligence throughout today, which indicates that the Islamic Revolutionary Guard Corps of Iran may launch an attack on Friday against Israel utilizing intermediate range ballistic missiles, land attack cruise missiles, and one-way suicide drones. So that came on the heels of that, and VIX continued.
Yeah, and oil bounced around, right around that time too, put a bottom in around noon, and really accelerated from like 145 on. So there was some talk about Israel taking folks out of embassies and opening up bomb shelters. Look, this is the the world we live in with whether or not news is real or not, who knows? But there was enough headlines going around in the afternoon. Positioning was kind of set up the other way that it started to lead to a bit of a VIX move and kind of put the market into a precarious situation, into what is a very important data point tomorrow
Yes, let's talk about that.
on payrolls. And so I think we would have seen, some hedging and some volatility, for tomorrow, kind of regardless of the war stuff, just because of payroll. But this obviously exacerbated that situation. And so payrolls tomorrow, it's become it's back to being as crucial a data point now as CPI, because the Fed, is suggesting that their dual mandate is coming more in line, risks are more balanced. When inflation was running as hot as it was, it made sense for the Fed to focus on the inflation mandate, kind of exclusively, and particularly when unemployment was, running 3.5%, right? There's no reason to even look at the unemployment rate. Everything was about inflation. But as inflation has come down and is more in striking distance of target, and we can argue that it's not going to get there, it behooves the Fed to look at both sides of the mandate. And so they've all, Powell and most of the members have really kind of keyed in on, the reason that they could consider cutting would be a deterioration in the labor market. And it seems like they're more hip to moving sooner if the labor market rolls over faster. Hasn't happened yet, and there's really, not a tremendous amount of evidence that it's here and now on this report tomorrow. But look, I mean, to the extent that we got a very soft payroll print for tomorrow, I think we would very rapidly move June cuts into perspective, right? I mean, we kind of for a moment there earlier in the week, after the strong manufacturing PMI, odds of a June cut dropped to about 50-50. And now, they're back up 65, 70%. They'd probably go to 100%, if we got a very weak payroll number tomorrow, because I think that is something that the Fed has said, in this election. They haven't said it because it's an election year, but it seems like the idea is, okay, the labor market will at some point is moved from 3.4% to 4+% and triggers the SOM rule. And, it's time to start putting accommodation back into the economy. And so that is, I think, how they would handle it. On the flip side, if we got another very hot labor market print tomorrow, and Powell last week said that the labor market is, quote, very, very strong. And the manufacturing component of the labor of ISM was okay. The services component was not as good and was below 50 now for the second month in a row. So we know services drive the economy, services employment. From the ISM non-manufacturing survey typically has a good leading indicator correlation to the NFP print. So, there's a chance that number could come in a week tomorrow. But if not, look, I think the Fed would have trouble articulating why June cuts are needed if the labor market remains as robust as it has been. And then we kind of transition into next week's CPI. If that comes in line to hot, then you're talking about, 3 months in a row of data that kind of moves against where the Fed thought it would be coming into the year. And so far they've said, through 2 months, they're not, Powell has said through 2 months, it's really not that different from what he was thinking to, at the beginning of the year. Other members have said that the data is, not that it's a concern, but that it is coming in better than expected on the growth front and worse than expected on what they would like to see on the inflation front. So if we got 3 months in a row of that, I think we would be, moving the conversation into a place where people would have to really start to price in the potential for no rate cuts this year. Because if we don't cut in June, it would be very difficult for them to start the cutting cycle in July. Because it's not a meeting that the Fed has a dot plot. It's also kind of right in the middle of the convention season. The meeting falls between the Democrat and Republican conventions. So kind of maybe would be seen as a fairly political decision if that's what they decided to commence their cutting cycle. That leaves then September, which is, so close to the election, although it does have a dot plot. Look, I think at that point in time, if the economy was on the ropes and markets were reeling, yeah, sure, they would cut. But it's almost like we need to see the markets react negatively to the idea that they may not cut in order to bring out the cuts, at that point, if that makes sense. So, look, tomorrow's a very crucial data point. And the fact that, we're kind of going into it with vol a bit elevated, probably means if it comes in soft, but not catastrophic, if it comes in soft, but is not catastrophic, vol's going to get sold and the market's going to rip back back up again. And then you'll have to kind of maybe hedge for the weekend risk around geopolitical stuff. But
I want to show
we'll
a
see what
chart
happens.
because I know that folks are not, who are attending here are a lot of macro focused and not technical, but I have to show VIX because it really speaks to what you're talking about technically, and then we'll talk about the NFP. So you can see, hopefully, this is obviously VIX. I actually am showing this because VIX is in a potential Bollinger Band squeeze. And already identified that, as you know, for clients back here at 12:45 and suggested some $17 calls because that's typically where this would kind of move higher above the 50-week and then tap out and get sold. So the fact that we literally ricocheted, this is the intraday, the hour, the day, the weekly. Again, here's the Bollinger Band squeeze. It's already starting to open up. But like you said, depending on that market reaction to the NFP, wouldn't surprise me if they do, sell this and tap it back down. But it did tag 1692, and that is worrisome if it sticks. But otherwise, it is a great place for vol sellers to come back in and create a little market bounce. So on the NFP, do you think I know we don't know until tomorrow, but as it relates to typically when we get a lower NFP print helps the imply weakening economic growth, weaker dollar, and Fed cuts, right? But if we have wage growth that's very robust, which we just saw recently this week, then that kind of does the opposite. They might balance each other out. But long story short, I'm looking for higher unemployment rate over the next few months. So I think we've already had that move from 3.7 to 3.9. We will start to move higher. Why? I'm sorry, but the market has had so much in returns in one quarter. We can't possibly annualize that. 10% isn't going to become 40% this year without QE. But why would we bounce? Strongly move higher on the potential Fed rate cuts if the market shows it's clearly deteriorating? Wouldn't we at some point just call uncle and say, okay, this actually trumps a Fed cut?
Yeah, look, I think ultimately the Fed will be cutting rates because the economy is deteriorating. And it's likely that those first cuts are going to do nothing to help the economy, right? Just because, if we cut 25 basis points, is that going to stop whatever impact of tightening that we've had for the last, 2 years? Probably not. Not many companies really are complaining so much about cost of capital being a deterrent for them to hire people. So once the Fed does start cutting, it'll be because things are bad. And so there's countless examples throughout history of equity markets selling off when the Fed is cutting rates, because those initial rate cuts don't do anything to help stabilize the economy. They don't do anything to help corporate earnings. So yeah, I think that is that is something to consider. I think what we're dealing with now, though, is still because inflation is hot and because now oil prices are moving higher, gasoline prices are going to go, obviously war kind of changes the dynamic too. But even without war, oil prices are moving higher, gasoline prices are moving higher, and headline inflation momentum is continuing to move higher. I think a stronger labor print tomorrow would, force people to think, shit, maybe the economy actually is a lot better than we think, and we're really not going to get these cuts because this economy doesn't really, quote, need them, right? We heard that a lot from, some of the Fed, from Fed speakers over the course of the last few days. It's like Waller was like, what's the rush? Barkin today was, we have, the ability to wait. Kashkari was, similarly, we could wait. And if it's, and Mester, right? Mester, Barkin, Bowman, Waller, these are voters, and they're all thinking, let's just wait. Let's just keep waiting.
And 2% not until 2026, says Bostic.
And he's a one-cut guy, and he's a Democrat, right? So, there's this idea that the Fed is this political animal and is trying to save, the economy for Biden. And you have, one of the most Democratic members of the Fed who's looking for one rate cut this year and maybe none. So I don't really put a lot of, credence on that specifically, that it's purely political. But I think there is enough data here to just wait, right? And I tweeted about this today, but there's no humility, right, at the Fed. It's growth has come in higher than expected. Labor market is tighter than expected. Housing hasn't fallen like they thought, and inflation is stickier. and yet their confidence that they're going to get back to 2% remains, very robust, very high. It's like they can't acknowledge that this time is different. I know those are dangerous words, but when you have a government that has deficits at 5-6% of GDP from now until forever, and debt to GDP of well over 100%, this is a different economy. This is a different environment, and the Fed doesn't seem to be acknowledging that. And so I think they are being just too dovish, just broadly. I mean, this asymmetric idea that it's very hard for them to raise rates from here, but it's very easy for them to cut, just doesn't make a lot of sense to me. It's not clear that the economy needs that level of accommodation. Now, clearly there are segments of the economy that struggle amidst high rates. That's always how it is. But the Fed's supposed to be looking at holistically, at the entirety of the economy, and it's the private sector economy. Monetary policy in aggregate is not restrictive, and that's why GDP is continuing to print hot. That's why the labor market remains strong, and that's why spending remains good. And so the data points that we get here on labor and on CPI will be important. And I think if they come in kind of better than expected, holding war aside, it's going to be hard to deliver on that rate cutting regime that I think Powell wants to kick off.
All right, let's talk a little bit to this chart, if we could, and then actually no, first on the inflation, the CPI print, when and what are expectations, since that's the next big print after NFP?
Yeah, so CPI is next Wednesday, the 10th. The street is looking for 0.4% headline and 0.3% core. That's month on month, and that'll be 3.5% headline and 3.7% core. Now, interestingly, the CPI year on year headline is going back up. Right. So it's going to go from 3.2 to 3.5%. And so I think that is the first kind of headline pickup that we've seen in quite some time. And so, you have this idea, at least I have this idea that, how's the Fed going to really be able to message why we need rate cuts when headline inflation is going up? Clearly they look at core, but Americans look at headline. Right. Mm-hmm. And so there's a dynamic in play there optically about, well, you're going to lower interest rates while while oil prices are going up, and why headline inflation is reaccelerating. So I think it just raises the degree of difficulty as headline inflation continues to move higher. But really, core is important, and core was obviously a big beat in January, and super core was a huge number in January, and those rates kind of slowed down in February, but they were still hot. And so, a third month in a row of that would really cast doubt on the inflation reduction momentum that was seen in the second half of last year. So, look, I think that's it's a very important data point coming next week. The other thing we have next week is we have this dynamic of Treasury supply, which is huge, right? We have 3-year, 10-year, and 30-year auction next week, Monday, Tuesday, and Wednesday. Big auction. It's going to raise, net $50-something billion, I think, by the end of next week. But we also have, the cash drain that happens from people who have to pay their tax. And so we're going to start to get a pretty big rise in the TGA from the middle of next week through the end of the following week. So say from, I don't know, people probably start paying their taxes on, the 12th, which is a Friday. And then there's a weekend, Monday's the 15th. And then the receipts kind of go into the Treasury over the course of that week. And that could raise, $250 billion gets pulled out of reserve and goes into the TGA. There's a couple charts going around about the historical kind of performance of the stock market in the days leading up to tax day and a couple days after being kind of weak. That's part of the reason why is that people have to sell stocks and raise cash in order to pay taxes, and so that's going on next week while there's a tremendous amount of Treasury duration issuance that's happening, and that'll lead us into kind of the following week, which is expiry. And so we're setting up here for potential period of weakness from the macro perspective, depending on how the data goes and the flows are negative. But then we kind of transition into earnings season. And so I think JP Morgan is next, kicks off maybe end of next week. And then everybody, industrials, and then the big tech companies after that. So the market will shift its focus from the Fed, to earnings. And, typically during those periods, we get choppy trading on indexes, and we get a lot of beats and misses that are, depending on positioning. And so less macro, more micro.
I do have a chart. Since you're talking about earnings, I want to highlight. I've shown this in the past, and I pull it out every once in a while when we get kind of into an inflection point. And since I think the market's tired, and this is just, case in point of a divergence when it comes to earnings. This is GAAP SPX, and it's on a quarterly, so it goes way, 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 way back. But SPX is down here, and you can see, obviously, we've made a resumption higher in price, but the GAAP SPX has actually made a lower high and is intonating a rollover. So we have a situation right now where even XLK has NVIDIA with the only forward revised higher earnings estimates. The rest have been revised downward in tech. We actually have some weakness in tech that I'm spotting right now in a big picture. And it will be very interesting if we do have an earnings season that disappoints, tighten this up, if you will, or cross this over. That might be trump, if you will, the Fed cut expectation. Any comments on that?
Yeah, it's been a quiet pre-announcement season so far. I haven't really, heard a lot of. Retail's been bad. So that's
yes.
which makes sense, right? I mean, the consumer wallets are getting crimped to here. And so, there's been some weakness there, but, with industrials and materials and energy, stocks have been great.
Inflationary stuff is great.
It's been good. So, we'll have to just kind of see. And clearly that transition we've talked about, out of tech and into what? Is it going to be out of tech into cyclicals? Is it going to be out of tech into defensives? Is it out of tech into small caps? I think that jury is still out, and it will depend on kind of how earnings come through. Now, I think it's clear that energy has been a big beneficiary of the out of tech flows because commodity price momentum has, been exceptional, to start the year, and crude's up, double digits, and that momentum is good. Materials too benefit from, the moving gold or the moving copper and the moving, broadly speaking, in materials. And so, the question will be, is that sustained? Or are we, at a point where those stocks have kind of run too hard? I mentioned today in the room that, my indicators on the energy ETFs are very, very extended, kind of almost record extended. It doesn't mean that they're going to crash tomorrow. It just means kind of think about protection, and they can alleviate those overbought conditions in time or price. But, we've pushed that trade.
Do you have that chart, or can I grab that, or it doesn't matter?
Can you see that?
Yep.
So I mean, this is right here, XLE 100 percentile, XOP 100 percentile, LIH 100%, 99.5, XLB materials is 99.3. And then you can see up here, gold 99.4. So look, I mean, I think, and then as far as very oversold, you can see some of the tech stuff, right? Here's Tesla, here's Apple, but nothing too violent on the oversold stuff yet. But the equity market, the internals of the equity market are saying inflation is back. Inflation is going to be an issue. And I think the question is, when will the Fed kind of acknowledge that, and when will they react to it? And I think, and I've said this, equities probably wouldn't top out until the odds that the next move was a hike were consistent with the next move being a cut. And I don't know if we're going to get all the way there, but, the equity market is trading like it wants to test that assumption for the Fed, right? Energy is moving higher. Headline inflation is reaccelerating. And yet you listen to all the Fed speakers and they say, we could hike, but very, very unlikely. But if labor market falls, we definitely will cut, right? So that asymmetry is still there, and it's giving the market feeling that the Fed put is still alive. And I think, in order to really break the heat on the market, the Fed needs to come in and say, we actually are concerned that things are overheating again. This pent up exuberance that Bostic has talked about, we actually don't think we're going to be able to cut 10 times in the next 2.5 years and still bring inflation back to 2%, because that's what they're priced into the dot plot now, is close to 10 cuts over the course of the next 2.5 years, and that's just seems unlikely. it just seems unlikely that they're going to be able to deliver that degree of easing. The market doesn't believe 10. The market's only at, I think, 6 or 7, but still,
It's still 6 or 7.
It's still, yeah. And so how do we get to 2% with that degree of accommodation being added back to the economy? I think we don't, but the Fed still thinks they do. And so I've said this and others have as well. You trade the Fed you have, not the Fed you want. And so, but there are times where there's an inflection, right? And that the Fed realizes they are that they've made mistakes. We haven't heard enough from them thinking that that they need to transition away from the desire to cut this year. And they may not get there. I don't know.
I'm going to bring this chart up because I bring it up every week when we meet with clients to get your updated read, which is the 10 and the 2 and 10 year yield curve as it relates to this is a weekly, this is a daily. We're in this wedge in either regard. I still feel quite, convinced that at some point we're going to come back down and tag and fill this gap fill at deeply inverted -60. We've been there before. But it's not a timing tool, right? This is just at some point we're going to cross down, we're going to go get it. But for right now, as this moves higher, it's dovish in short. Yeah. And as it moves lower into this wedge, it's hawkish and it's way early. But I bring this up because I have another chart, and I've talked about the 3-month or 13-year Treasury yield index is also in a Bollinger Band on a weekly, which basically implies that it's going to have a big move one way or the other. And in talking about this, I had someone send me this, which was the same idea, right? Did I put this in the right screen? Let me just make sure. Yeah, you can see it. And it is just that, which when the 3-month, rolls over, then we have reason to worry. So looking at the 3-month, looking at the 10 and 20 yield curve, thoughts?
Yeah, I think that's, you have 2s, 10s there, which is what you want. You said yes. 20, but you meant 2s, 10s. Yeah, look, I think it's, like you said, I think when we get 2s, 10s kind of simplistically to me is a reflection of whether or not the Fed is going to solve inflation and bring it down to 2% or whether they're not. And so when we steepen, which is that curve moving higher, that's the market saying the Fed is not going to bring inflation back down percent, that they are going to cut rates, bring down yields on 2s, and that will be inflationary for the back. And so long end yields can rise. And so that's kind of how you get your steepener. And then on the flip side, we flatten and that chart goes down when the Fed says, actually, like, we need to be higher for longer, we may need to tighten more, and we are really, really serious about bringing inflation down to 2%. And so front end yields stay elevated or move higher, and back end yields move down because the Fed is serious and it's going to hit growth and people are going to get laid off. And so that is the dynamic. And it's not surprising to me that we still are in this wedge. And I don't know when we're going to break out, if it's going to be by the May meeting or if we have to wait all the way to June to really figure it out. But we have 3 CPI prints between now and the June meeting. So we get we'll get a lot of data between now and then, and it'll be definitive about whether or not they can really cut in June. I think that if the data remains good, they will not be able to cut. The challenge will be if the data is strong and the market starts to sell off and financial conditions tighten, how much tightening of financial conditions will the Fed tolerate in an election year? I'm not sure. I mean, I guess we'll have to just kind of see the path. I would have thought they would have been able to tolerate more and markets can really correct. I mean, we're up, 1,200 or so handles from the October lows. I mean, you'd think that there was some ability for the Fed to allow the equity market to sell off a little bit. But we
haven't had a 2% day.
200, yeah, it's 150 days or something, some long period of time. I don't know how long it's been, but
exactly. October something.
So I was just to conclude, but they definitely react when bond volatility gets moving. So bond volatility, we talked about this last week, had kind of moved down. The move index kind of broke through the lows, and into quarter end. And I put a poll in there and asked people if they thought that was going to be risk on or risk off, because the breakdown and move could either lead to a portfolios feeling comfortable about grossing up exposure, or it was foreboding in some way. And 2/3 of the people on the poll said it was risk on. So, not surprisingly, given that was the market consensus into quarter end, now we obviously have a decent bounce here in the MOVE index to start this quarter, and a market that is a little bit on the fritz, for lack of a better word. But the point was that the Fed will be monitoring fixed income volatility, and we can look at the MOVE index as a proxy, for that. And if I just kind of pull back here, this is, in September of 2022, when the gilt crisis was going on, the MOVE index kind of blasted through 140. The Fed, intervened here. This is SVB. And the MOVE index kind of moved through 140 into 160, and the Fed intervened. Here is in late September, October, when term premiums were moving higher, and yet Janet was selling treasuries, and yields moved higher, and the MOVE got to 140, and the Fed intervened. So they have a history of intervening when bond volatility is elevated. Right now, bond volatility is not elevated versus how it's been over the last, let's call it 2 years. But, to the extent that Treasury volatility rapidly picked up because of, oil, because of slowdown, whatever the reason, I would imagine the Fed will come in again and do something to ensure smooth market functioning in the Treasury market. And unfortunately, or fortunately, I don't know, however you look at it, they are inhibit. They are, what's the word I'm looking for? They're the ones who basically are allowing these budget deficits to go uninterrupted, right? They are not allowing bond vigilantes to come in to kind of punish DC for profligate spending and deficits as far as the eye can see. They don't allow that market mechanism to work because they are concerned about demand for treasuries. They're concerned about, the US's power and all sorts of things. And so DC is completely dysfunctional. We've talked about this. There's no ability to raise taxes. There's no ability to cut spending. And so the only way to improve the budget deficits is for the Fed to cut rates and to drive asset prices higher to help bring in more tax receipts, inflating away the debts. And so the question is, when will the Fed do that again? Because Congress can't get, its act together. And so that's probably going to happen when the MOVE index is at 140 again. So if we get there, depending on how quickly we get there, will determine when the Fed feels like it's time to add liquidity back. And we'll just keep trading this kind of same game. And in the meantime, the rest of the world is trading away from dollars, and gold's being reintroduced as a neutral reserve asset. And the geopolitical tectonic plates are shifting. So just a question of how long this goes on for.
How about Yellen's visit to China? Any?
I mean, look, I've written.
It's early. I know.
I've written a fair bit about this, to clients, and I put out a couple things on Twitter as well. And look, I think that it's possible that the administration, Fed collectively realize that we need a weaker dollar, and it's in our strategic interest to weaken the dollar over time in order to, reshore manufacturing, in order to rebuild our supply chain, and in order to become competitive in global export markets. And that the actions to sanction Russian reserves in the spring of 2022, and really kind of dictated a changing of the guard in how foreigners view their U.S. Treasury holding. And so if you believe that if you're a government and you think that it's possible the U.S. will expropriate or sanction your reserves, you're not going to build those reserves anymore. And so that was a strategic mistake, I think, for the U.S. to sanction and expropriate Russian reserves. I think we're starting to realize that. And I think we started to realize that more after the BRICS meeting last year in August, where more countries were included into BRICS, Saudi, UAE, Iran, and drove oil prices higher, which drove U.S. yields higher, bonds sold off, dollar rallied, and I think really scared the shit out of Yellen and the administration and Powell, and forced that late fall pivot to kind of buy some time to prevent the bond market from blowing up. And so Yellen, and part of that is China, right? And so we rolled out the red carpet for Xi and for MBS in San Francisco to try to make some sort of peace with the Chinese. And we are trying to convince them to strengthen their currency, stop dumping goods, stimulate domestic demand, and allow the U.S. to weaken its currency. And so part of that, plan is Yellen going to China and begging for the Chinese to do that. And so, look, I think she's there now, and that's what she's looking to do. She's trying to talk tough and force them not to dump goods, but ultimately, China has a lot of things in its court. But I think the world needs a weaker dollar. Everybody benefits from a weaker dollar. And so, the question is, does the administration are they willing to, let go of strong dollar policy, allow for a weakening that will improve domestic manufacturing capabilities, job growth at home, and potentially be disinflationary over time? Or will they kind of continue to, stick with what we're doing here? So I think that's why she's there, and we'll see, what ultimately becomes of it.
In the meantime, in the in-between time, both you and Jeffrey nailed this precious metal move higher trade. And I'm just showing a ratio of gold and silver because it smelled it in advance, right? So, you've got your macro narrative. This is an intermarket tell. It's very bullish. Gold had obviously started spiking higher March 1st, and then silver really went into warp speed this past week. Long story short, this is a very bullish chart. It's on a monthly. So the worries plus what's going on, escalation with the Middle East, separate from Yellen, going to China to beg for what, we're not sure. But the point is, this is still a very, very bullish chart, although it's moved a lot. What are your expectations now as it relates to precious metals as a relief valve for what's going on with the dysfunction? Like, how this to me says very bullish, but I'm asking you, what's your continued?
Is that that's gold to silver, or what is that?
That's gold. That's gold and silver. Correct. So it's just it just
yeah.
is,
Look, I think I've been bullish gold for a long time. I continue to be bullish gold. I think gold is a call option on the dysfunction of central banks and governments and the spending and the rest of the world kind of shifting the settlement of excess trade balances in gold rather than in U.S. Treasuries. And I think that trend is in place and will continue. And look, that would explain the disconnect between gold and U.S. real rates, which have been disconnecting now for at least a year, because gold buys more energy in the East than it does in the West. And so there's a pull of gold into China to help buy more energy. And I think that trend, will continue. And so now the U.S. can either allow it or it won't allow, because I think weak gold prices and strong dollar kind of exude U.S. power, and high gold prices and weak dollar exude, power away from the U.S. and most specifically power towards China. And so I don't know if everybody in the administration or the deep state is, believes it's time for the U.S. to, make this move or allow, China to be bumped up into a hegemony like we are. But that seems like the rest of the world is starting to act as though it's already happening. And I see a comment in the chat about that BRICS are a joke. But look, the truth of the matter is over a third of oil transactions are being done away from dollars. And that number's up from basically 0 5 years. So and the more that China trades with Saudi and UAE and Iran, and with Russia, and India trades with Russia and Iran and Saudi, right? The more that they're pricing energy in their local currencies, and they're settling the excess balances, the excess trade balances are being settled in gold. And so that's why the gold is being drained from the Western vaults, and it's moving over to Asia, because BRICS are trading and using gold as an energy currency. So I think that's what's going on.
Sorry, I didn't mean to play that.
Yeah, and so I thought, I wasn't sure that was you or me. But so look, I think that's a structural reason to keep owning and keep buying gold. It's overbought here on my indicators, but I think it's a buy every dip. As far as silver is concerned, I think silver, is more of an industrial metal that could get dragged up in kind of the hard asset trade. I don't view silver as a monetary asset. I don't really believe, I believe it's been demonetized. So really it's more like copper than it is like gold in a lot of ways. And it's obviously very important to many growth industries and semis and in renewable energy and a bunch of other places. So from that perspective, it should do okay as an inflation asset, but I'm not viewing silver as needing to make some sort of, historic move and outperform gold because it's going to be, introduced as currency. I think it's more of an industrial metal.
And India also, by the way, loves silver, not just gold. Okay, so what I was actually, I didn't mean to play it. I just wanted to show it, which had to do with more downgrades occurring on junk bonds, and yet the spreads are tight. And there was basically this interview that was talking about how more deals are getting recorded, the pipeline for M&A, for example, for investment grade, because the demand is there, but spreads haven't widened. There's absolutely no risk priced in. So the market really feels very, very complacent in regards to also the credit markets. I'm just kind of curious if you have any thoughts in regards to this growing kind of risk of downgrades not getting priced into the spreads. High yield iOS, for example.
Yeah, look, I mean, as long as we're printing, 5-6% of GDP in deficits, like it's going to be hard to get a nominal growth slowdown in the US, which is, what would trigger, real issues, at least for investment grade companies, right? These are companies that they have pricing power, broadly speaking. And so I don't really think there's a lot of risk yet. So that's why spreads are at basically the tights that we've seen for, at least since the beginning of 2022. And even, I think, probably even back to, I'm just pulling back a chart here. But
right here.
Yeah, I mean, we're basically at the low end of the range for the last decade or so, right?
Correct.
So, you're not really getting a lot of incremental value by owning IG credit versus the government. However, look, this is maybe too, I don't know, out there, but in my view, there are some corporates that are better credits than the United States government. And so I know that sounds ridiculous, but the U.S. government
have some pushback there.
The U.S. government has no pricing power, right? They have no ability to raise taxes, really, and they have no ability to cut spending. So they are not a great credit. Whereas there are IG companies that have better ability, like Microsoft, they have pricing power and they have an ability to cut their expenses to pay off their debt. So now you could say, well, Microsoft can be taxed, it can be regulated. When? When is it going to happen? I mean, they could be. We've been talking about taxing and regulating these companies for a decade or more. So yes, at some point, the U.S. government is going to have to come in and tax these companies and regulate these companies more. But until there is any momentum on that, you could argue that some of these companies are better credits. And so I just think that's why IG specifically is trading so tight to treasuries. It's like most of these companies have pricing power, very easy for them to refinance, very easy for them to pay their debts. And so to the extent that you're an investor, you can earn a little bit incremental yield by, buying Procter and Gamble and buying your US Treasury. You're gonna do it. Now, I think high yield, eventually as the economy slows from tightening, that's going to stay out there longer. We are going to see more strained, junkier areas of credit. So, and those are the areas that less pricing power, have maturities coming up in the course of the next, 6 to 24 months, depending on how long they were able to lock in borrowing during COVID. So that's going to be, a refinancing wave that's going to hit junk credit, for, a couple of years. But again, it's slow maneuvering. It's not something that is kind of, right here, right now.
All right. By the way, this is open. If you have questions, we've got about 10 minutes left. If you want to ask, hit it right in the Zoom Q&A or webinar chat, and we'll go through and kind of.
I see this question here about investing in T-bills. Look, I think that owning T-bills here, short duration, 1, 2, 3, 6 month T-bills here at 5% plus yields is still a very attractive place for money. I don't anticipate
and it might not be there for very long.
Yeah, look, I mean, the question is what is going to trigger the Fed into an imminent rate cutting cycle that doesn't hit equities way in a much bigger way than it hits the front end. I think if we go into obviously if they go into a war, God forbid, but that is typically not something that is good for equities. We may get fixed income rally on that. But your T-bills still are yielding 5%. And so you'll have cash around to deploy when we get weaker asset price. As far as the long end is concerned, I'm just still concerned about the deficits and that they will be inflated away. So I just don't think that buying a 10-year or 30-year government bond at 4.5% is enough margin of safety, is enough compensation for the increase in inflation uncertainty, the uncertainty about DC. And so I just think that buying the long end with term premiums basically flat when they've historically been 100, 150 basis points positive, I just don't think it's a good bet. So I'd rather be in the front end with T-bills to store cash. And as far as gold is concerned, I like just buying gold outright. Either you have some physical, but also, you can own gold futures. And look, I think for now, you could still own some of these ETFs. I would prefer people, even though GLD is more liquid, you're probably better off trading the Sprott ETF because we know that they have the gold in the vault, whereas GLD, there are some concerns about how that could be settled in the event that gold has a massive revaluation. You could kind of get screwed in some way. So I think
I have to just show you the CEF, which CEF actually is the Sprott physical gold and silver. I just showed you that ratio analysis chart that I look at every single day. It is a silver ratio chart, obviously. It looks identical, this chart.
Yeah.
And I didn't notice that in CEF. I only look at my ratio chart every single morning. Anyway, they look identical. It's very bullish. Mexico, Dean said he kind of likes the look of some of the assets, but I think Carlos is asking more about the peso. So this is true. There is a great chart. I've shared it with clients as a potential swing or trend trade with EWW. And this actually was going gangbusters into 2023 before peso had a hiccup. So, but of course, everything looks like this November 1st with the Fed pause and Yellen Yahtzee. It's been digesting sideways and starts to look like it wants to move higher. Any thoughts on Mexican assets or specifically?
Yeah, I mean, I think part of the reason that Mexico has the peso has done incredibly well is because it's a commodity exporter, right? It's a hard currency exporter, unlike the Asian emerging market currencies, which have all weakened against the dollar lately, whether it's China, Japan, Indonesia, India, Thailand, South Korea, they've all kind of weakened, and they're all, forget Indonesia, the other five are energy importers. Mexico, though, has a hard currency because it's oil based, and it's also benefited from kind of proximity to the U.S. growth story. So I don't really have too much of a view. I mean, obviously, it's been probably one of the best performing currencies around for a long time. There's plenty of carry trade in there with yen mex crosses. And so look, I think in an environment where we go risk off and the dollar rallies, there's definitely a lot of length in Mexico and Mexican assets that could be sold. But other than that, I don't really have too strong of a view about the next direction.
How about the SLR? It's the further up. Marty's asking thoughts about changing the SLR bank supplementary leverage ratio so they can hold more treasuries in order to absorb record treasury issuance, refunding in coming months or years.
Yeah.
And there's also the ISD, what's it called?
That's look, I mean, the Treasury has acknowledged, and they put this slide out, and I put this on in our room and on Twitter that foreign demand for U.S. Treasuries is declining and will continue to decline. And so the Treasury needs to figure out new buyers or make the existing buyers bigger buyers. And so I would anticipate that, and this is what the letter that came out earlier this month, earlier in March, suggested, which is kind of making the SLR exemption permanent, making it permanent. SLR exemption during COVID allowed banks to hold treasuries on balance sheet with no kind of capital charge against them. And so effectively just, free leverage, buy as many treasuries as you want, and we're not going to charge you the capital for that. So I suspect that is what is going to happen again. I just, typically these things occur in periods of crisis. And it's not often that we put these types of regulations in place before shit hits the fan, because, you know, they're generally contentious to some people. Like why are we giving banks the ability to just, or why are we, you know, giving banks the ability to make free money again, right? Borrow at basically zero and buy treasuries and make that spread. Like, why is that really politically a thing? But we know that saving the U.S. Treasury market is of paramount importance to the U.S. and to the Fed. And so we allow these things to happen. But typically it takes a little bit of crisis. I would say so far we have seen really no crisis. But I do think that the SLR reform will happen and that banks will not be charged to own treasuries. And we'll see banks and primary dealer holdings of treasuries kind of, increasingly replace foreign holdings of treasuries. And I'm sure, that'll help keep the bond market from completely blowing up, in the course of the next, few months and quarters and probably years. But, the U.S. continues to need to find buyers of treasuries if you're going to run these types of deficits. And, as you move away from foreign buyers, you need to find price sensitive borrowers. And so, yields are going to move higher in that regard. And I think that's what the government is wrestling.
All right. So final thoughts. Basically, cutting rates never really doesn't help the real economy. And it's actually usually a trigger for equity sell-off. We've got some weakness that we may see in banks and earnings coming up in a few weeks. We need to get through CPI next, non-farm payrolls tomorrow, CPI next week. We'll meet again probably in 2 weeks and then again on Fed Day. That's what we typically do. Which is literally 1 month away. It seems like forever. Any final questions or comments before we get, a review and kind of just say stay safe out there, because we have Yellen coming back. We've got
look, I think we are in a place here where the market is challenging the narrative about inflation being under control, and is forcing the Fed into an uncomfortable place where it may not be able to deliver rate cuts this year. And I think markets will rallying, broadly speaking, until that point. But we also have to kind of keep in mind that Yellen and the Fed have different abilities to allow this to go on or not. And at the end of April, beginning of May, we have another quarterly refunding announcement, which will be very important, because this most recent one was where Yellen gave the view or gave the prediction that bills issuance would be negative this quarter, and that duration issuance would be up 500 billion. And so what happens next quarter if, let's say, tax receipts come in better than expected? There is some thought that the tax receipts could come in better than expected because asset prices have been so good, and so capital gains last year are good. And so maybe there's, an ability for the Treasury to kind of lower its borrowing needs again for the next quarter. If Yellen takes that opportunity to lower duration issuance, that would be, in my view, an entirely political move and would be very asset bullish, very risk on bullish. What she should do is that she should take the opportunity of the higher than expected tax receipts to continue to lower the share of bills issuance. And so make the third quarter a negative bills issuance quarter too, because we don't need to keep funding the government with 4 week to 6 month paper to the degree of 75 or 80% of every incremental issuance. Over time, the Treasury is supposed to only have 15 to 20% of outstanding maturities in bills. And right now we are above 20%. We're in, I think, the 22-ish% camp. And so she should be reducing the bills issuance and increasing the bond issuance in order to bring that ratio back down below 20. If she decides not to do that in May, that would be a very political decision, and it would be very much risk bullish. So it's an important.
But that leverage of over 20% is actually highly discouraged. It's an instability kind of meter. So they really don't. The fact that they're over it is very clearly sounding political.
Look, I mean, it's clear to me that Yellen has been a very political Secretary of the Treasury. She really, I probably didn't give her enough credit in the beginning, but she's a very astute observer and knows the plumbing and knows the dynamics and knows how to play the markets. And so what she should do versus what she will do is unknown, and we'll have to trade accordingly. But I would say that if she decides to make that political decision to cut duration issuance at the May QRA announcement, it's because she's looking to gun it into the election. And so we'll have to keep that in mind. Now, can they do that when if oil prices are ripping for the next few weeks and inflation expectations are threatening to become unanchored? It's going to be very difficult to do that, because then we're going to really rip assets for the next few weeks, and then the inflation will be the election issue. And I don't think the administration wants that too. So very interesting.
Watch term premia, because this is typically when they take advantage of that, very positive term premia that, versus negative. And right now, I think we're equally balanced around
Yeah,
zero,
we're basically at zero.
Right? Yeah. One chart I want to show, it's not really a chart, but it is a warning. And that is because I have been obviously very bullish, 53.40. And then I probably, maybe too soon, but I said 53.40 or bust. And I think it's going to be bust. I don't think we're going to get there. And we haven't gotten there yet, but there's still potential. It are the CTAs in the house, which are the price insensitive sellers that, when and if we do get a solid 2% drawdown in SPX, which we haven't had in 150 or 250 days, I don't even know how long, this would really trigger some of this selling. And case in point, this is a chart most recently where Goldman came out and said, again, this is in addition to the fact that, buybacks are in blackout period. But if we were to have a down week, then we could actually see some of this 156 billion, which CTAs are long, to the 100th percentile, historically speaking, they could start to lighten up. And if we really were to start getting some selling, they would lighten up to the tune of 141 billion. So that would definitely trigger, we're already in negative gamma, but that could exacerbate the problem of negative gamma, and selling can beget selling. Up until now, we've had no 2% down day, so it really hasn't been a risk. But just kind of keep that in mind. There are forced sellers if we get some serious selling.
Yeah, I mean,
That's
we're on a knife's edge here, I think. And I could see a lot of reasons why the market should really start to correct. But there also are triggers that the Fed and the Treasury can pull to prevent, disorderly market behavior, for lack of a better word. And I think, gold's strength and probably Bitcoin's strength is a reflection of the notion that neither one of those entities are really going to let this get out of control, and that when shit hits the fan, they're going to come in with money, and they're probably going to do it at levels of risk that are kind of higher than before. And so gold and Bitcoin are already anticipating the liquidity that's coming. And, I don't know how the Fed or Treasury are going to break that cycle. And maybe they need
maybe they don't want to until later.
Maybe they need the oil price to go up in order to assist them breaking the cycle, right? Because when oil goes up, everything can be blamed on oil. Right? Like you could blame inflation on oil. And then maybe that could help slow the economy, bring inflation down, and the Fed doesn't have to rush in to cut rates. And so we don't just jack up asset prices again, right? When oil moves higher, it just kind of dampens the overall economy. So maybe, oil moving up here is something that they could use as a way to let them get to the point they want to have at policy without making it seem like they're just there to placate the markets. I don't know. I'm just kind of thinking
they need the dollar to also come back down, even more than it has from that 105 area, but we'll see. We break 100, it's a whole new ball game in Dixie, but 105 to 100, we've been basically bouncing while the market has moved higher over the past, year after 2022. So far they've had a lot of control over oil not getting too hot, dollar not getting too high, yields that intervened clearly at 5%. The one area they really can't control is in fact gold. So it's a fabulous tell as far as I'm concerned.
Well, look, there's something to be said for this fact that if, gold having a significant revaluation is like the best way to transition the global economy out of the malaise that we're in right now and do the least amount of damage to, like, who really cares if gold's at 4,000? versus 2000, right? Like
Miners will love it.
no, I'm just saying, like, for the world, like, I think this is a type of, like, temporary end game that most people in the world would be fine with, right? Oil, I mean, China, Russia, they all own a lot of gold.
They own a ton.
They'll be happy.
India,
They all,
Turkey even.
and in America, like, people who have owned gold forever will be happy. But the issue will be, can we orchestrate that kind of move without it being very inflationary first? And
Good question.
I don't know the answer to that. I suspect no is the answer, but it's worth kind of thinking about. It's worth asking and worth kind of understanding it. But gold at 4,000 and is, no one would blink. If we were there tomorrow, no one would blink an eye. But a $2,000 an ounce, the U.S. can revalue its gold on its balance sheet and pay off, a couple $1 trillion of debt, and then we don't look so bad anymore, right? So, but at that point we've officially given up the post 1971 world of dollar hegemony and the U.S. power. And, are we ready to do that? And I quoted
slowly is fine. It's actually very productive for trade balance. It's also productive to this regional globalization shift. Let's keep that happy thought.
Yeah, there's what's the Churchill quote about America? It's about, like, they'll do everything. You can always count on Americans to do the right thing after they've tried everything else, right? So that's kind of where we are. It's like the world, like, the joke is, like, everybody knows, like, the Chinese and the Russians have been calling for this for 15 years. We're screwing over Europe completely by forcing them to buy energy in dollars, and they can't trade with Russia. Like, we're totally screwing them, and Japan as well. So, like, the world needs to move on from this system, but America has to kind of give up its power in some way. And so we'll see. We'll just see how quickly the powers in DC kind of recognize that and how they want to transition to do it. So,
all right. Well, on that thought, I will wish everyone a great rest of the trading week, and thank you so much for joining Macro to Micro Power Hour. And
take
you can
care.
also,
all right.
Yeah. Thank you. Bye-bye.
Okay.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.